This episode is brought to you by Alibaba.com, the world's leading B2B e-commerce marketplace. They'll help your business stay competitive and discover new, innovative, and affordable products from over 200,000 suppliers and manufacturers worldwide. And with their trade assurance, you can shop with peace of mind. No more worrying about international payments, delayed shipments, and convoluted refund policies. Even customized orders receive protection. The world of business is waiting for you. Visit Alibaba.com.
Every success you've had began with a great opportunity. Now, here's another one. Make your next career move with a degree from University of Maryland Global Campus. Choose from more than 125 degree and certificate programs featuring online courses, faster onboarding, and no-cost digital resources in place of most textbooks. Get started on your undergraduate or graduate degree or certificate online. No application fee through May 31st. Learn more at umgc.edu/podcast. Certified to operate by Chev.
This is Optimal Finance Daily, episode 2345. How to Stretch Out an IRA for Your Beneficiaries by Jeff Rose of GoodFinancialSense.com. And I'm your host and personal finance enthusiast, Diana Merriam. I'm going to keep this intro nice and short, so let's get right to today's post as we optimize your life. How to Stretch Out an IRA for Your Beneficiaries by Jeff Rose of GoodFinancialSense.com. If you don't expect to deplete the assets in an IRA during retirement, then it's a good idea to determine the most efficient way of transferring the account balance to your heirs in a manner that preserves the account's tax-deferred growth potential for as long as possible. For many Americans, transferring wealth with a multi-generational stretch IRA can be an ideal solution. By naming a younger individual as the beneficiary, he or she will be able to stretch the life of the IRA by making smaller required withdrawals based on his or her longer life expectancy. With a stretch IRA strategy, more money can then remain in the IRA with the potential for continued tax-deferred growth. For those who don't currently have any IRA beneficiaries, the stretch technique could provide significantly greater long-term benefits than simply allowing the account balance to be paid out to your estate as a taxable lump sum distribution. Stretch IRAs were made significantly more convenient when the IRS revised the rules governing required minimum distributions from IRAs. The three key rule changes affecting stretch IRAs allow you to, number one, name beneficiaries after required minimum distributions have begun. Number two, change beneficiary designations after the account owner's death. And number three, receive RMDs as a beneficiary that are calculated based on your own life expectancy. Whether you've amassed assets in an individual retirement account by making regular contributions through the years or by rolling over a lump sum distribution from a workplace retirement plan, you may want to consider whether it'll be necessary to use all of that money to support yourself during retirement. If the answer is no, or even maybe not, then you'll need to determine the most efficient way of leaving the account balance to your heirs while simultaneously safeguarding your accumulated wealth for as long as possible. Stretch it out. For many Americans, transferring wealth with a multi-generational stretch IRA is an ideal solution. A stretch IRA is a strategy for a traditional IRA that passes from the account owner to a younger beneficiary at the time of the account owner's death. Since the younger beneficiary has a longer life expectancy than the original IRA owner, he or she will be able to stretch the life of the IRA by receiving smaller required minimum distributions each year over his or her lifespan. More money can then remain in the IRA with the potential for continued tax-deferred growth. Creating a stretch IRA has no effect on the account owner's minimum distribution requirements, which continue to be based on his or her life expectancy. Once the account owner dies, however, beneficiaries begin taking RMDs based on their own life expectancies, whereas the owner of a stretch IRA must begin receiving RMDs after reaching age 70 and a half. Beneficiaries of a stretch IRA begin receiving RMDs after the account owner's death. In either scenario, distributions are taxable to the payee at then current income tax rates. It's worth noting that beneficiaries also have the right to receive the full value of their inherited IRA assets by the end of the 5th year following the year of the account owner's death. However, by opting to take only the required minimum amount instead, a beneficiary can theoretically stretch the IRA and tax-deferred growth throughout his or her lifetime. Added perspectives. Your enhanced ability to stretch IRA assets is a direct result of an IRS decision to simplify the rules regarding RMDs from IRAs. The new rules allow beneficiaries to be named after the account owner RMDs have begun, and beneficiary designations can be changed after the account owner's death, although no new beneficiaries may be named at that point. Also, the amount of a beneficiary's RMD is based on his or her own life expectancy, even if the original account owner RMDs had already begun. Consider the implications. The ability to name new beneficiaries after RMDs have begun means that you can include a child in your stretch IRA strategy regardless of when the child was born. The ability to change beneficiary designations after the account owner's death means that one beneficiary may choose to disclaim his or her own beneficiary status so that more assets pass to another beneficiary. For example, if an account owner names his son as the primary beneficiary and his grandson as the secondary beneficiary, the son could remove himself as a beneficiary and allow the entire IRA to pass to the grandson. RMDs would then be based on the grandson's life expectancy, not the son's life expectancy, as would have been the case if the son remained a beneficiary. When there's more than one beneficiary, RMDs are calculated using the life expectancy of the oldest beneficiary. And the ability of beneficiaries to base RMDs on their own life expectancy means that the money you accumulate in your IRA and leave to heirs has the potential to last longer and produce more wealth for younger generations. Keep in mind that this information is presented for educational purposes only and does not represent tax or financial advice. While it's true that recent regulatory changes have indeed made it easier to incorporate a stretch IRA into your multi-generational financial planning initiatives, it's always a good idea to speak with a tax professional before implementing any new tax strategy. Stretch IRA in action. Assume that you leave a $100,000 IRA to a 5-year-old beneficiary who has an estimated life expectancy of 77.7 years, according to a current IRS life expectancy table. If the account earns an 8% average annual rate of return, its value could grow to $1.67 million by his or her 55th birthday. That amount is on top of nearly $790,000 in taxable RMDs that would have been withdrawn from the account during the 50-year time period. You just listened to the post titled How to Stretch Out an IRA for Your Beneficiaries by Jeff Rose of GoodFinancialSense.com.
This episode is brought to you by Alibaba.com, the world's leading B2B e-commerce marketplace. They'll help your business stay competitive and discover new, innovative, and affordable products from over 200,000 suppliers and manufacturers worldwide. And with their trade assurance, you can shop with peace of mind. No more worrying about international payments, delayed shipments, and convoluted refund policies. Even customized orders receive protection. The world of business is waiting for you. Visit Alibaba.com.
It might not always be talked about, but one of the biggest concerns for business owners is keeping their companies safe. Improve your company's cybersecurity with our sponsor, NordLocker. Now with NordLocker Business, you can secure and control your business data in an end-to-end encrypted cloud. See and manage the organization's data via your admin panel. Your business data stays protected from data leaks, ransomware, and theft. Thanks to NordLocker Business, you're able to manage members in the organization, inviting, suspending, or deleting users. You can also set up roles, user, owner, or admin, to make sure that data is only accessible by the right people. And not to mention, you can check and manage your license limit and the number of currently active users, access business settings, and control file sharing outside your organization and recover your account. It's time to make sure your company is protected. See NordLocker Business in action now with a 3-month free trial by visiting nordlocker.com/creators with code OFD. That's a 3-month free trial when you visit nordlocker.com/creators and use code OFD. In general, if you inherit an IRA, I highly recommend you consult a tax professional because the rules are constantly changing and it's way too easy to mess this up from a tax perspective. Also, consult your CPA and your estate planning for the same reason. This article doesn't say it explicitly, but I believe it's talking specifically about traditional IRAs. These are subject to tax upon withdrawal and have RMD implications. However, a Roth IRA has different rules. Your beneficiary will be able to inherit the account without any tax or RMD implications. If the person inheriting your IRA is your spouse, in most cases, they should take over ownership and treat it as their own versus as a beneficiary, as this is the most advantageous from a tax perspective. However, if the beneficiary isn't your spouse, in many cases, they're subject to the 10-year rule for inherited Roth IRAs. They must empty the inherited Roth IRA by the end of the 10th year following the owner's death. Strategically, the beneficiary will want to leave the money inside the inherited Roth IRA and withdraw the money in December of the 10th full year following the owner's death to get as much tax-free growth as possible. Roth IRAs can be left to one's own estate or trust, but generally speaking, they should not be. In order to qualify for the 10-year rule or better treatment, the beneficiary designation form must leave the Roth IRA to a human being. Does this sound complicated? That's because it is. While it's helpful to have a general understanding on how this stuff works, it's very difficult to figure out how most of this applies to your specific circumstances. This is where a CPA and an estate planning attorney come in. You all know I love to DIY my financial planning and investing, but I have found that CPAs in particular are way cheaper than a financial or investment advisor and are worth their weight in gold. That'll do it for today. Thank you for listening. Have a great rest of your day, and I'll see you on tomorrow's show where your optimal life awaits.